What's up, everybody? Welcome back to 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. We are approaching earnings tomorrow, and on top of that, we have a very lovely golden window as far as our price action heading into earnings. So we're going to break that down today. We're going to talk about what I mean by this golden window in the case of our market context, and why we're looking likely at some very strong some potentially very strong upward volatility heading into earnings. So we'll think about that as well as maybe some potential pitfalls to watch out for coming out of that in a trading perspective. Before we get into today, I also wanted to take a sec. I know, I've been talking about getting involved right with this PSA scanning and PSA grading, right? Going through a number of my old Pokemon cards I collected as a kid, or I'd have a bunch of 1999 originals and whatnot. And I happened upon this guy right here. So this is very happy to find. This is a first edition original holographic Machamp. This was one of my favorite Pokemon as a kid. I remember if you actually played the trading card game, like you played the original Game Boy game. I love the original Game Boy game. Somebody got this guy out on the field, like your ass was kicked, man. Like this guy was super cool. So interested to get this guy graded. Definitely if you've got these cards, I would recommend go checking this out. So I checked this guy out. He's got the little first edition thing here. If you get this graded as like a PSA 10, if you have like a card like this is probably, I think, the only like really first edition one I have. But if you get this, one of these, like the price history on this, depending on the quality, if you get a PSA 10, these sell for like, $5,000 to $7,500. So if you've got a box of these in your basement, like it costs nothing to go like get them scanned and check out like what version of this you actually have, because you can really find a gem like this, right? Like I had no idea I was going to find this guy. So excited to get this guy graded. Gonna head to GameStop later this week. Get this guy checked out, get this sent in, and then we'll see what the grading is, and then hopefully I can add it to my digital collection over on PSA. So looking forward to that. Okay, so let's get to our gratitude for today. Many thanks as always to our supporters, monthly supporters, Ken Wedmerlin and Scruffto, who on a regular basis offer to help me offset some of my data expenses. I spend thousands of dollars a year on my premium data subscriptions to be able to do this type of research. So both Ken and Scruffy are very generous each month to help me offset a bit of that. And then, of course, right today, today's letter is sponsored by Backwoods Degenerate. Wonderful name. Backwoods is great. He's also talked to him on several occasions. Does his own research, puts together some DD. Always great talking to Backwoods. So much appreciated for sponsoring today's video and today's letter. Also, of course, as always, big shout out goes out once again to Keith and Tabitha over at Fervent Coffee. Very excellent small roastery. Right, it was founded as a labor of love between the two of them, something that brought them together. So go check out Fervent Coffee. The link is down in the description of this video, along with today's article. I will say one thing I will say about this coffee. This is probably the only coffee I had that wasn't like a structurally like flavored coffee that says it has notes of blueberry and actually tastes like that. So one of the first coffees I've ever actually had where that was the case. So definitely go check them out if you get a chance. It's great to have everybody who's contributed in one way or another to be part of the community here. So very, very, very blessed to have all of you in my life. So thank you. Last week, right, we got pretty excited with our guy Sultan Almadid here. We've had unprecedented levels, right? Unprecedented levels, not unprecedented, certainly not unprecedented with GameStop, but we have some very high levels of high levels of hype heading into this week. Now, earnings is coming up, which is going to be great, right? Sultan Al-Madid pointing out here that if you invested in GME 5 years ago, you're actually beating Nvidia, right? Like GME over the past 5 years has been a better investment in terms of overall return than Nvidia of all stocks, right? So really, a lot of excitement heading into this week for earnings. A lot of promise. We talked about this, especially we broke this down in deeper detail on last week's live stream. So on Friday. So if you haven't had the chance to check that out, definitely go check that out either on Twitter or on YouTube. We have the videos there if you want to go into a deeper discussion there. But of course, what does this mean with respect to our price action heading into that? What's actually going to go on with the price of the stock, and how is that going to affect us? There is some reason to look bullishly, and a lot of that actually is going to have to do with our market context. So as we thought, right, heading into the end of last week, we talked about this at Friday morning's video. March OPEX, huge OPEX, right? Huge amounts of put gamma exposure to market makers at this expiry. A lot of long puts on traders and institutions who were essentially had established these positions to capture that month-long just straight downward plunge that we did end up seeing in March, right? We did see this play out in March. And what I had anticipated after Bank of Japan and FOMC announced last week that they would be holding their rates steady, was that what we would see in the price action would be we would see a quarterly recovery, right? The makings of a quarterly recovery, but into March OPEX, keeping things perhaps stable in order to allow those put positions to close in the money at their current valuations, and that traders and institutions would not be rolling that put OI. That was the key mark, right? If we got bad news, bad news if we had rates raising in the case of BOJ or rates falling in the case of FOMC or both, then that was going to indicate that we had a bit more pain, that some deleveraging was required with respect to the yen carry trade, which has been open for quite a while, given how long the Bank of Japan has had low interest rates. So we'd be seeing likely a little bit more pain, and likely we would see some rolling of that March OPEX OI, which would mean we'd be staying at lower levels. We might even see some deeper digging into April. And that's to say nothing about this tariff deadline that President Trump has set for the 2nd of April. Because we did not get that, we did not get a large roll of that put OI. And so now this week, with all of those puts expiring, we have the stock price freed up to essentially move back to the upside. And what do we see in our context, right? In pre-market here, we just kind of yoinked immediately up a few dollars, and we moved up over the 570 mark. So if we go and we check out our gamma exposure rate, we can see now this is a very different chart, right? How many days in a row for the past 4-5 weeks has every single strike just been blood red with put exposure, right? This indicates volatility. This indicates why volatility? Because as traders are long puts, dealers are short puts, which means dealers have positive gamma on their books, positive delta on their books that they are hedging by selling shares as those values go up. So as the stock price moves down, the positive delta from their short puts on their books goes up. The positive delta, positive gamma. So they are hedging that by selling shares. So as the price moves down into put gamma dominant territory, they are selling shares, which accelerates the rate at which the price goes down, which accelerates the rate at which they sell shares, right? So what this means in general is that in put gamma, trader long put gamma dominant territory, which we can assume that the long orientation with respect to traders and institutions is by and large the case over on SPY, that we are looking, when we see those conditions, at market makers, at options dealers hedging in sympathy with price action. So as soon as we get moving to the downside, it has this effect to kind of snowball, which is why we saw this just kind of fall through key layer after key layer after key layer. Okay, for 4 weeks, right? Okay. For the first time in that period, we are now out of that territory and we're now back into call gamma territory with some small bits of kind of volatility sprinkled in the 560 range. Okay, so what does that mean, right? So call gamma is going to work the opposite way. So now instead of having short puts on their books, which means positive delta, positive gamma, they have short calls on their books, which is negative delta, negative gamma. So they're going to hedge that position inversely to the way that they would hedge a put. So when the price goes down, market makers, options dealers are going to buy shares to hedge that, right? And as the price goes up, they're going to sell shares to hedge that. So they're going to oppose whatever current direction the price of the underlying is moving in. This means you're going to have, by and large, antipathetic rather than sympathetic hedging. Okay. So what does that mean? This means lower volatility overall. This means smaller intraday swings. And it means that the price will most likely, without a catalyst, just sort of slowly grind up to the upside. So that's what we usually see in broader markets, right? That's that gentle sloping, relentless curve to the upside, right? It's why we have volatile positions, right? We have little kind of dips. We have these cauldrons maybe that'll last for a month or something like that. But then we sort of move back to the upside and then have these slower moves, these like sort of slower grinding moves up towards large call gamma positions toward the overhead over a broader period of time. Okay, so how long can we expect this? How basically is the market? How long are they expecting these types of conditions to last? We do see that as we stay over 570 here, we have a ton of call gamma dominant positions and that we're largely kind of grinding up in this area. That's what's projected there. But how long are we going to be able to do that? So we take a look at our gamma exposure by expiry, and what do we see? In the short term, basically every single expiry this week, every daily expiry, and this weekly expiry. This is the first weekly expiry that's been positive, that is call gamma dominant, that I have seen, I think, in 6 weeks, at least 6 weeks. Really going back to like early February, I think. Early to mid-February is the last time we saw something that was this optimistic. Now, keeping in mind, that's still short term. 31, which is a daily expiry, we have a lot of GEX concentrated, positive GEX concentrated. That's next Monday. 4-2, we've got, well, it's very interesting, right? Because very interesting to see that mark, because 331 is an important date. As we've talked about, 331 is an important date in terms of swap rolls. We know that there are some swaps that are being rolled on the 28th, but we also know from looking at our swap data here. In fact, let's go ahead and take a look. Pop over to, let's see, to Matsy's data. That is very conveniently Reddit user Matsy's data, which is conveniently centralized on this this spreadsheet here. So we take a look at our GME swaps. We have notional amount. Let's see, we have our price, and now we got to scroll down a bit. Oh boy, look at all these things. Got to get forward to 2025, but we'll see that there is, I think it's around 40 billion in swaps that are expiring. I got to get through this. There we go. 40 billion in swaps that are expiring toward the end of this month. So we look at the notional value. Okay, we had some stuff around the 17th. The real guy was here, right? Of course, the Huang swaps, the Credit Suisse swaps for 10 billion, right? This is Bill Huang's Archegos swaps from 2021 that Credit Suisse inherited that were re-upped in 2023 just before Credit Suisse collapsed, right? The effective date was the day that Credit Suisse collapsed. And of course, if we look at the other swaps, right? We see everything else from 2023. What do we see here? 21, 22, right? These are the marks 18, 16, 17, right? These are prices that were actually seen in GameStop in 2023. But here, these swaps are swapped with a GME share price of $212. So we know that these are from 2021 because the price this is a pre-split price here, which is actually something right post-split over $50. Which GME has not been close to. And so if this is a short position, it's not looking good, right? So this was back on the 13th, and our deep price action heading into the 13th is in part suspected to have been in order to accommodate a roll of this swap. I guess, to get the best potential value there. Okay, so what about going forward, right? Okay, on the 28th, we can see here we've got several billion in notional value. I think it's approaching. Yeah, look, it's approaching. It's approaching several billion, right? Okay, it's approaching several billion. If these were short swaps, they are also not looking good, right? Because we've got prices here from 2023, from August 2023, or from 2024, March 2024, where we're seeing $15, $18, $14, $12. If these were short swaps, they're also not looking good. They are not looking good. They are very deeply underwater. And in fact, the lowest the price was able to get prior to last week's trading was right like 2150, which is like not close for these, right, for rolling these. We do have these coming up on the 28th, but as we look forward, we also have several billion in notional value expiring on the 31st. So very interesting to see these. These are in a little bit better shape, right? These are not quite, whether they're long or short or what have you. These bigger ones that are expiring on the 31st, right? Several hundred million per in notional value, doing a little bit better, right? That's not too far away from where we are. So maybe we don't move too violently to accommodate these, but it is very interesting to me why we would have on a daily expiry, like the 31st, why we would have the last day of the month would have such a large number of swaps on it. Not sure. Maybe somebody in the comments can enlighten us to a certain extent there. But right, of course, anyway, going into this week, we're still looking good in terms of basic optimism there. That's a decent amount compared to what's on the board now. Maybe we do see some volatility over the weekend into that, something like we saw with like the supposed DeepSeek dip or something like that back in February. That this DeepSeek news, whatnot, which was probably an options related move. And then going into April OPEX, right? We do still have April is still a decent sized put position. So in the short term, optimism, some recovery, maybe trading in the 570s, kind of maximally, maybe up to around the lower 580s if we get really bullish this week. But then depending on, I suppose, what's going to happen with tariffs on the 2nd, maybe this, whatever is concentrated here on the 31st has to do with some swaps, right? Not just GME, but GME included in a basket of other potential swaps that need to be rolled. And then possibly some reevaluation heading into April OPEX. But if this does look good, right, if we have no real material adjustments to make in terms of the U.S. broader market and economic situation, then all right, we kind of hang out. But once this gamma then gets off the board, maybe then we kind of open up and get that larger quarterly recovery as anticipated heading into later April, May, and possibly June before we get some more bank rate decisions and reassess the situation as a whole. If we don't get much material change with respect to tariffs, then I think the door is kind of open for that bigger quarterly recovery to take place. But of course, we'll have to see. Verdict in the short term, looking good. We have some optimism, not only heading into today, but heading into the rest of this week. We'll have to see how that plays out. What does that mean for GameStop? That means we're not going to have these ETF types of outflows, assuming this plays out as it looks like it will. We're not going to have ETF outflows being what's going on, right? We're not going to have ETF prices going down, which means that this removes a potential avenue of short liquidity for institutions who would seek to transpose GameStop's price down, right? So there are a number of different avenues of short liquidity. One of them being you can short ETFs directly. So if you short an ETF directly, that causes it to divest itself of some of the shares of its underlying companies. You can short that, right? You can have many, many times the percentage of the float short without showing that a specific stock is shorted, right? If, however, that ETF is increasing in price naturally because of broader market recovery, if you open a short position on that ETF, eventually that's going to do damage to your margin in the sense that that position is going to be decreasing in value. So that's going to influence your margin liquidity in a direction that you would prefer it not to go. Whereas if you see a broader market downturn and you open up a short position on an ETF, that type of move, which you would ideally use to suppress GameStop's price to transpose it down, is also going to be aided. It's going to be a boon for your margin, given that it will be appreciating in value, given that it's a short position. Okay, so in these optimistic conditions, that avenue is going to be taken away. So that's one less avenue under which we can see price transposition to the downside take place. What it does look like, especially because we've seen so much suppression of the price heading into earnings, it does seem that there is this kind of short-term pocket that would be available to see some more dynamic appreciation in GameStop, which we already started to see last week and heading into Friday, despite the fact that our volume was so low. So very interestingly, right, yesterday we saw this live on the stream, right? We got this big pop all the way up into the 2570s here after hours. Okay, what was that? So largely our scenario throughout the day conformed to the GEX situation that I outlined, right? So largely projected just looking at our gamma exposure, that charm from our in the money calls and out of the money calls had moved to the point where it was largely going to sandwich us, just as I have sketched here, between the $25 and $24 very large gamma positions. And that we would kind of dance around in the middle of that, supported by the fact that SPY was kind of generally bullish, not showing deeper dips to the downside. So that's what largely played out, right? Here we go. So we take a look at our price action, kind of posted this here, and we get this kind of undulation throughout the day and not really moving too far off that 2450 mark. However, that started to change toward the end of the day as a really, really large order came through for almost 1.5 million shares. Very unusual. I mean, that would have been good for more than half of the volume on any number of trading days prior to Friday's price action. So there it is here on Red Stripe Tie. 1.5 million on close. So what did I think this was? I think this was something like the options market maker probably delayed some hedging that it had to do. Wolverine Trading probably did that in order to prevent the $25 position from going into the money, right? So part of the issue and part of the calculations with hedging, if you're the options market maker, is you want certain strikes you would ideally like because you're net short the options at these positions. You organize things such that you are usually net short because that's how you make money on the on your options dealer strategy. That you end up net short on, say, something like the $25 call position, which you hedge dynamically, right? But ideally, you want to plan for that $25 position. It's a very big position. You have over 10,000 contracts at that position. You would like that to be out of the money, right? Because that influences your profitability. You don't want to have to go and deliver shares on that. You don't want to actually have to have, you would like every single contract to expire worthless. So you have some options, right? Okay, you can do things like if it starts to go in the money, you can go and borrow shares and direct short the stock and try to pin it under, right? But of course, that also has its risks because you have to then have that position open. And what happens if, the following week something happens, it moves up, it teleports up overnight, and then your short position's underwater, and then you got to close it, and then it hurts you the next week. So that's a potential strategy. It can be used, but maybe that's not plan A, right? But what you can do is because you are the market maker. You are the options market maker. You understand that you drive price action. Your hedging activity with respect to your options positions is what drives most intraday price action, especially on lower volume days like this. Your hedging activity is what drives the price action. So what do you do if you don't want the $25 position to go in the money as a result of your hedging behavior? Stop hedging the position, right? Stop hedging the position intraday. You only have to wait until 4 p.m. Eastern time. That's when you get the print. So you can wait until that mark. If we close, right? We close at 24.75. All of those $25 contracts out of the money, don't have to deliver on them. Okay. Let's say though that you still have to hedge that $24 position, which was very large. So you could just not hedge the $24 position or the 24.50 position during the day, knowing that you have to deliver those shares on Monday. But as soon as you get the options print, then go ahead and hedge all those shares, right? So then go out and say, okay, now I'll buy these up because I need to deliver them on Monday. but I'll just wait until the after hours because, man, we could shoot up to 26 or 27. It's not going to matter. It's not going to affect the options print. So what do I think? I think probably this price action was related to options hedging from throughout the week, that the market maker largely just said, we're going to hedge these in the after hours. Yeah, it's going to make the price go a little bit nuts, but we don't want those 25s, which was a call wall position, right? That would have required, I forget exactly how many contracts were open. Actually, I have it down here, right? Well, this doesn't tell us by strike. Still ended up with quite a few in the money, but I think it was something like we have 10,000 open already just for this week. So I think it was like maybe 18,000 contracts, which correspond to, I think that corresponds to 1.8 million shares. So if that position went in the money, the market maker would be on the hook to purchase an additional 1.8 million shares, whereas the 24s were also very large, very close. I think the 24s were around 15,000 actually. If we just, we can figure this out, right? So if we bump over here, we take a look at, oh no, we can't see it here. But don't worry, we have our trusty, dusty history. This is why it's nice, right? Write articles on this. We can go ahead and take a look at what we had last week. So we take a look at last week's articles. Okay, so heading into that day's trading, what did we have at 24.25? Okay, we had just over 10,000. So to hedge these two positions completely, this would have been over 1 million shares of delivery obligations that would have had to have been hedged. So if the market maker just waited until close, then the market maker could have bought these and potentially did, right? Could have maybe bought the 23.5s too, who knows? Could have just bought these in the after hours and then delivered them later to ensure that these 17,000 contracts did not go in the money, which they did not. Okay, so right, a little underhanded maybe, but certainly not outside the rules of what they are allowed to do. Okay, so now we see our prices moving up. We did have a lot of OI rolled into this week. Calls at 27 and up were largely done at the ask, so they're assumed to be mostly trader long. Below that, we do have a lot of short, right? Primarily aimed toward the bid, not insanely so. But I will say that the most interesting one is the $23 position. So almost all of these were short puts. So these are trader short puts, meaning they're dealer long puts, meaning $23 is going to behave like it is a call gamma dominant position, in the sense that there's a bit more hedging support from the options market maker as a result that the options market maker is long this put gamma, meaning the gamma on their books is negative. So they're going to be hedging that negative gamma and that negative delta by purchasing shares as this position is approached, if it's approached, right? That's what's to go there. So Max Payne looking like it's going to be at 24 for this week. MaximumPain.com says it's at 10, which is weird. I like them because they are more up to date, whereas Chart Exchange doesn't do it right until market open. So we could refresh Chart Exchange right here. And what do we have? Up to the minute. All right. Well, next week's is up to 25. The following week, yeah, next week's is up to 25, which is interesting. This week's still at 24. Yeah, so not 10. I don't know what's going on with Maximum Pain there, but good to see. And yeah, so what are we looking at in terms of our gamma exposure today? What we can see is we have a reemergence of this $25 to $30 bracket, right? We see these kind of macro brackets, these $5 intervals that establish our most likely trading ranges throughout the week based on how we can anticipate the market maker is going to hedge their short options positions heading into the trading day, heading into each trading week. So as we can see, a lot of gamma exposure below 25 is basically not super present currently. Over this 25 position, we have hedging support to the downside. We have a clustering of call gamma up to about $27, and then we have the call wall, the largest net call gamma exposure position across all of our strikes, So $30 has become our new call wall. So we have this formation once again, right? We've seen this pop up a bit. This is largely what we were dealing with up to the last week of December, and then for the first few weeks following January OPEX. So basically from post January OPEX, even kind of the tail end of January OPEX, like kind of around the 15th up to like February 21st, I want to say, where we saw this again. We saw this basically, this was our principal gamma exposure layout for basically all of November, basically all of November and all of December. So this is what we were looking at. So this formation is back here again. And what does this project? Trading within this range. We're currently toward the downside of this. Projects intraday hedging support at $25 and a run potentially up to 27 if we do have some large bullishness. Like I said, we do have contextual bullishness with respect to SPY. Not crazy, but it's there, right? So the context is there. Then we've got, because we're still approaching earnings, if we do start to move pretty notably to the upside, dealers are going to have to Vanna hedge a significant portion of the already existent options positions, which are primarily calls. So as Vanna ticks up, if we start to move to the upside, they're going to have to delta hedge their call positions, their short call positions by purchasing shares. That's going to put a little bit more of an upward move, at least into earnings, coming out of earnings, unless we really move to the upside as a result, like into the kind of upper end of that bracket. If volume gets kind of back up to like 8 million, 10 million per day, that might be enough to return GME based on price action to a level of implied volatility that won't cause too disruptive of a deleveraging event, or I should say not deleveraging, of a de-hedging event coming out of earnings, right? Because as we come out of earnings, that IV, because that background effect of IV, right? So this trend here, right? This background effect, which has not been caused by price action. This has been caused by the fact that we're just approaching earnings. That background effect is going to disappear, right? That background IV is going to disappear. It's going to drop away by about 20 to 25 percentage points. And that's going to have the inverse effect on Vanna hedging. So immediately, for all open options positions that take that loss of IV, dealers are going to Vanna hedge in the opposite direction. So IV is going to project that they have less exposure, less risk. Vanna is going to go down. Accordingly, delta is going to depreciate. And so they're going to cut a sizable amount of their delta hedges on those open call positions. So unless we get like crazy bullish out of earnings, then there's going to be that kind of net to the downside move, and it's going to be a little bit bearish. But before earnings, we do have that Vanna hedging effect in place. I would say that I'm a little cautious coming out of earnings, because even if it's bullish, we do have these two potential swap roll dates, so the 28th and the 31st. So I am cautious of that. I am cautious of the idea that potentially institutions may try to walk the price down, right? They still have short liquidity, right? They still can use the short liquidity. They can use direct shorting. They can use their ETF FTD strategies and sort of open up FTDs to push them out to May or something like that. That's still all on the table. They will have that kind of IV crush and the Vanna de-hedging effect coming out of earnings, no matter how bullish it. Well, not no matter how bullish it is. Yes, to a certain extent, right? We will lose the points of IV because of the passing of earnings. We will need to see large, volatile, big movements in the price in order to preserve those IV points, to have them replaced by price action related implied volatility points, if that makes sense. Yeah, so I mean, I'm very optimistic in terms of what we're expecting here in the very short term, but also trying to be aware of hype, also trying to keep in mind what we can expect, right, with respect to these swaps, and as well as how our future expiries in terms of the broader market can inform us about what we might be expecting contextually, a couple weeks down the road. So yeah, that's it for today. Thanks very much as always for watching and listening. Very excited to see what we get in terms of earnings. We will, we'll have to see. But thanks as always, of course, everybody for supporting the channel and for being a part of this and helping support, mission here over 21st Century Renaissance. Yeah, thanks very much, and we'll see what the future brings. So thanks very much.